Today, we're going to talk about trading for newbies. If you've never been in the stock market or you're just now getting into trading stocks, this video is for you. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and live well in retirement. Well, one of the ways that people build wealth for retirement or learn to make money even for today's expenses is trading in the stock market. With all of the volatility lately, it's really been a big topic. So let's talk about it. I'm going to take you through 8 areas that you need to be aware of if you are new to stock trading. The first area, and it's one I see a lot, is new traders don't realize what they don't know. Now, clearly, stocks are a huge area of expertise, and you're not going to jump in and know everything. So it's really important to understand how little you actually know. The idea that you can jump in and be an expert at it tomorrow is unrealistic. You've got to go in with the idea you're going to have to educate yourself. And you're going to have to continually educate yourself in order to be successful long term. Number 2, you really have to check your ego. It is easy, especially when the market's going up, for everyone to think, oh, I'm a trading genius. Every trade I make is a winner. It's awesome. That's not true. One of the biggest issues with ego is people thinking because they're intelligent or very successful in one area of life, let's say they're a doctor, they're a lawyer, they've really climbed to a high degree of expertise in one area, they make the mistake of thinking, well, of course I can trade stocks. I mean, Yahoo does it. I could do it. It's not that big a deal. Oh, it is. It is a big deal. It's its own field. You know, I get that a lot too in the book world. People saying, oh, I'm going to take a week off and write my book. No, you're not. And even if you do, it's going to suck. So you have to understand, you've got to check that ego. You are not smarter than every person in the room. You are not going to have some kind of magic secret in the beginning that's going to help you succeed. So keep your ego in check, because you can convince yourself that every trade you make is going to be a winner, and before you know it, all of your trades turn to losers. Number 3, read several different viewpoints. As you're educating yourself, read several different viewpoints on the market and on trading. Read people who come from a technical perspective. Read people who have specific programs or specific techniques they use. Read people who are bearish. Read people who are bullish and understand why. You have got to look at different perspectives. The only way to be truly successful when you are trading in the market is to be able to distance yourself from one idea or the other and make good decisions based on your knowledge and your data. You've really got to make good decisions based on a lot of different things. You can't just take one viewpoint and buy into it 100% and expect that to work for the long term. So you're going to develop your own style over a long time, but the only way to do that is to understand various different viewpoints. And this leads us to number 4. Understand the underlying principles to what you're doing. For example, if you are really interested in the technical analysis, chart analysis, all those technical, your net asset value and all your moving averages, and you're really into that technical aspect, that's great. On the flip side of that, it only takes you so far. The market is an emotional creature. And these swings, especially the intraday swings, the intra-week swings, a lot of times someone, the Fed chairman, whoever, will get on television and say something negative and the market takes a dump. That is an emotional reaction. And it's very, very important to understand the emotional side of it as well as the technical side of it. You need to understand both basic data and psychology, how fear affects people, how people react to greed. And that's true in the market. If the market's in an upswing, greed makes people believe it'll always go up, even though they know better. You have to understand basic human psychology. If you are the kind of trader that learns both sides, you will be a much more well-rounded and much more successful trader in the long term, because you understand both areas and you understand the principles that underlie them. Number 5, find someone with experience doing what you want to do and learn from them. Now, this doesn't necessarily have to be a professional person, but it can be, especially if you have one in your family and you can ask them questions for free. That's awesome. But it can also be someone who has day traded or retirement invested their own money for more than 10 years. Now, the reason I say 10 years is over that amount of time, there will have been at least one, if not two, recessions. They will have seen a lot of industries rise and fall. They will have had their own issues. They will have winning stock picks. They will have had big dog losers. They will be able to shortcut your knowledge. They'll be able to shorten that learning curve and help you understand things better, faster, than if you had to make all those mistakes on your own. If you can learn from a pro about what not to do, that is just as valuable, if not more so, than learning what to do. So if you can, find someone that can tell you some of their tips and tricks that they have learned over time to be successful. Number 6, and this is probably one of the most important things you can think about, is good money management techniques. When you have a pool of money that you are trading with, most pros will tell you never spend more than 5% on any one event. What they're telling you is you have to diversify your risk. You have to spread that risk out. Now, when you're trading the market, there are a few exceptions to this, or caveats, I should say. They're not really exceptions. If you're trading exchange-traded funds or mutual funds that are already spread among 200, 300, 500 companies, that helps mitigate your risk. That is why those investments are so popular and so good for people who are just learning about the market. It allows you to invest even with a small amount of money and spread that risk. But over time, especially if you're trying to pick individual stocks, you do not want to put all of your eggs in one basket. Don't bet the farm on one stock. That is a tremendous risk. You want to divide it up. And if you're starting with a small amount of money, learning to manage that small amount and do things that are smart is way better than trying to hit the long shot. Don't do that, because you'll need to build those funds up and then diversify your risk. Number 7, check your emotions. Do not let the fear of missing out on a trade or a market upswing convince you you have to do something right this second without having researched or without having good knowledge about what you're doing. That anxiety and that anticipation of the big win can convince you to make a trade that's not well thought out. That feeling like you're going to miss out, or you could get another $10, you could get another $20. You don't throw good money after bad. You just don't. You have got to really think about things. You have got to be able to step back. And you can't do that if your emotions are all wrapped up in the win. The win. You can't do that. You have got to keep your emotions out of it. You cannot make good decisions based on the emotion of the moment. That is a danger sign. When your emotions are getting wrapped up in it, it's time to step back. Number 8, know when to step out. This is one of the critical ideas. If you are obsessing over your trading, you're looking every hour or every few minutes, you've got it up constantly, you are probably invested in way too risky a manner. You do not have any comfort level around how you're invested. That is not good strategy. That is fear-based. When you're obsessive and your mind can't get out of that loop of worrying, you can't sleep, you've got to constantly check it, you can't be away from home, the market might do something, okay, that is a danger sign. And one of the habits is when you lose, to keep trying to win again, to keep playing, to keep, right in there and just doing one thing after another. And what happens is you lose one big trade and then you make bad decision after bad decision after bad decision, and it leads to a spiral downward that can devastate your trading account. It can devastate you personally. When you find yourself being that obsessive and getting really wrapped up in it, that's a time to step back and reevaluate. Okay, sometimes you need to step out for a while, whether that's a month, whether that's a quarter, that's okay. There are a lot of people when they trade, they may do 4 to 6 trades a year. They don't trade every day. There are people who do trade every day, and that's great for them. But you've got to figure out your own level of risk. And you can't allow that fear to convince you to throw good money after bad. Now, I hope you will take these 8 areas into consideration, and as you travel along your journey of trading and learning, they will help you not to get into those big pitfalls. Now, if you've enjoyed this video, please click the subscribe button, and I'll see you next time.